Okay, so the second part of the chapter 4 is on revaluation rules. So, I mean, as you can imagine, you might be coming across this for the first time. But again, logic is the first thing you need to apply, and then you need to work to the logic with the T accounting. Because the T accounting is slightly different, but it's the same answer you should arrive at. I mean, imagine you have, it's always about the difference between the value and what something, when I say the value, what the carrying value is, right? What the carrying value is and what the new market value is. That's really the revaluation, the difference. If someone said by how much is something revalued, it's the difference between the market value and the carrying value. That's what we're really going with this. So, so I think that's kind of the first thing I want to say. Let's go to the theory, and then we'll see how the T accounting applies. So IAS 16 permits revaluation of plant, property, and equipment. You don't have to, but IAS 16 allows you to do it. So in accounting, we have the cost concept, right? We have the cost concept. And when you have the cost concept, you can choose to leave it at cost, or you can choose to revalue. So generally, businesses can decide what they wish to do. But if you do choose to revalue, you must revalue all the assets within a class or category. So for example, if you have all buildings, you can't revalue just one building. You have to revalue all, if you like, all your buildings. So you can't be selective about it. So you have to actually, and the thing about revaluation is you have to revalue regularly, right? It says you say revalue at regular intervals. I mean, you have to make that kind of judgment because you've chosen to no longer keep things at cost. Right, so revalued assets should be depreciated over the remaining useful lives. So it doesn't mean that because your revalued depreciation ends, you will still depreciate for the year or for whatever the period is, probably the year, and then revalue again at the end of the year, right? Depending on how regular you're doing things. So I'm going to do an example to kind of look at a lot of this double entry, to make it a bit more kind of visible, a bit more real. But the key point really is that increases if there's an increase, if you're selling something off and there's an increase. So say for example, you sell off an asset, and basically any profit from selling off an asset, so to speak, or based after evaluation, will go to this other comprehensive income, because you see this other comprehensive income has nothing really to do with trading profit. So we're leaving that income, if you like, it's still income, but we're not banding it or mixing it with normal trading profit, right? That's what this is really saying. So I'm going to do an example. All this is just kind of is sort of saying, how do we deal with the revaluation? What do we debit and what do we credit? And then I'm going to do an example now to show you how this actually works. So this revaluation surplus is a new double entry so it's a new T account that will be created to record the increase, if you like. It tells you here revaluation surplus within equity. So a decrease in the if something has fallen in value, well then yes, you will have to recognize the loss, if you like, straight away, right? So this is what we're sort of saying. But this is telling you if there had been a revaluation surplus before, then you'll have to deal with that first. And I'll do the example first, but you can sort of see what's going on. They're really telling you that imagine you had a building for 100,000. I'm just making some assumptions here, and then it went up to 150,000. So that's wonderful. Oh wow, it's 150,000 now. So the building's gone up by 50,000, but you now have this new revaluation surplus, if you like, what 50,000 in there. What they're telling you is that, so you have debit asset 50,000, the increase in the asset because there was 100 there before, right? You've now put 50 in and 50 to revaluation reserve, and this is sitting within equity. And what they're telling you really is that if for any reason this falls in value, so if this falls in value by 20,000, well, you don't have to put that 20,000 through the income statement. You have 50 here, so you can sort of drop this by 20, for example, and just drop this as well by 20. So you keep dropping this up to the point that you've used up the 50 here, then you go into the income statement to then hit your income statement with the loss. And that's what they're really going. So which is why you can see here debit revaluation surplus or profit and loss to recognize the fall in value. Okay, right. So let's I think what's a good idea is to yes, these are little things that you will see when you're doing it, when we do an example, but you can sort of deal with the additional depreciation. When we do an example, we'll sort of see what's going on here. So they're really telling you that if, for example, you were depreciating, if your depreciation was say 100 every year, let's just say, for example, and you had revalued, and your revaluation happened to be say say 5,000, for example, and as a result of this extra revaluation, your depreciation, you now have in your revaluation account, let's just say you have a revaluation of 500 or something, and as a result of this revaluation, your depreciation was going to increase to maybe say 300, for example. What they're telling you is put 100 as normal, and you can transfer the extra 200 from the revaluation reserve to top it up. That's kind of the idea, what they're really telling you here. Right. But if you don't have to do that, but if you want to do that, so they're basically telling you that you can realize that you can use some of that revaluation surplus as part of your, to pay off, or to include that as part of your expense. But again, like I said, we'll see an example. I think that's always a good thing. Right. So in the financial statements, a disclosure note is always required, so you should always tell us what's going on with this business in terms of what the cost is, what the accumulated depreciation is, what the class of the property and plant and equipment is since the last reporting date is. You just need to make us aware of these. You just need to outline very clearly what these are. And this is the typical layout, isn't it? I'm sure you've seen this before. So you have your land and buildings and motor vehicles, and you have your costs. You just want to know what's going on here, and your accumulated depreciation. But with all of these, you have to jump into a question to sort of see what's going on. And we tend to call this now pretty much cost or valuation, because you can have a range of valuation techniques being used to measure it. So not everything is actually held at cost as we know it, historical cost, but there might be valuation going on there as well, or evaluations. So let's jump again and look at a question in the workbook. Let's do the question in the workbook, and then of course we will do questions in the exam kit as we go along. So it says here, on the 31st of December, Eagley PLC revalued a building. So you just have to really follow the question carefully. They're quite straightforward. You just have to really look at the question and do the T accounting. That's the best way. I always recommend to do this as you're going along. We actually have two buildings here that we're talking about, but let's look at the first building. It says the building originally cost 5 million. So that's your building, and your building originally cost 5 million. And this is some time ago, right? And it says that this building has an estimated useful life of 50 years. Okay, great. So if we bought this building for 5 million and it's going to have no residual value and an estimated useful life of 50 years, okay, great. So we know straight away, okay, you're starting to think, yeah, you can sort of work out, if you like, what the depreciation is going to be every year. But this question is actually quite kind. They tell you, oh, accumulated depreciation at the date of revaluation. Oh, great. So you don't even have to work anything out. So you're thinking, okay, that's my accumulated depreciation. My accumulated depreciation is 1 million as well. So really your net book value is 4 million, isn't it? So just by looking at this, which is what you always want to do, just do the logic first. The value of this building is 4 million. Someone has told you this building is now worth 5.5 million. So that means that this building has, if you like, gone up in value by 1.5 million, right? 1.5 million. So there's been an increase of 1.5 million. So you know that your revaluation reserve should show 1.5 million. You know that. The question is, how do we get the T accounting to do this? So in T accounting, what we deal with first is, because this building is going to be sitting now in your balance sheet at 5.5 million, like just building with no accumulated depreciation, right? Because it's a new building. So technically it's 5.5 million for building, but nothing for accumulated depreciation, because there's no depreciation once, there's no accumulated depreciation once you revalue the building. There can't be. It's a brand new building. So the first thing we have to do is to eliminate the accumulated depreciation. So we debit accumulated depreciation and take it to revaluation reserve. You can see now that that's gone. And then all we do is just top up the building by the additional 0.5 and 0.5 million. So we can see that we're arrived at what we want. We want 5.5 million showing in our building and 1.5 million showing in our revaluation reserve. And that's how you deal with a revaluation. Just a straightforward revaluation that has an asset, an accumulated depreciation, and creating a revaluation reserve for it. Right, great. Let's look at the second scenario. It tells us, the second scenario says that several years ago, so this one again is just all double entry, just being really cautious and careful with what's going on. And you can see it's pretty straightforward as well. So it says several years ago, this company called Lapsong revalued a building to 3 million, recording a surplus of 100,000. So they're telling you that they had some revaluation reserve, and they had 100,000 in there. They did some revaluation some time ago, and they revalued it several years ago to 3 million. So this building, if you like, when they revalued at the time, so the 100,000 sitting there, but they're telling you now that the cost of this thing is 3 million. And over a number of years, of course, it now has an accumulated depreciation. So it has an accumulated depreciation of 400,000. And I'll put that 0.4 million. You can call that 0.4 million. I mean, the same thing, right? 400,000, 0.4. So this is the scenario. Now, you have this 100,000 here, and you can see what I was saying earlier on about if you start depreciating, you could transfer something from here to the depreciation if you wanted to. But the key point is you have this revaluation reserve that you had when you initially revalued it. And so far, you've, I don't know, they don't really tell us how many years, but that's not the key point. The key point, they tell us the accumulated depreciation at the 31st of December 2002 is 400,000. And it says now that what's the word? Someone comes in and says to you that this building is only now worth 2 million. So now this is a bit interesting because the question here is, how do I deal with this how do I be prudent? How do I deal with this devaluation, if you like? So just logically looking at it, let's logically look at this. Right now, this building is currently 2.6 million, technically, right? This building is worth 2.6 million, and we also have this kind of 100,000 surplus sitting here. So you could argue that really, if this building is worth 2.6 million and someone is telling us that it's fallen all the way to 2 million, yes, it's fallen by 0.6 million, but we have 100 here that could offset, if you like, offset this. And really, we know in our heads really that the fall is really 0.5. Is really 0.5 million, because this is a surplus, right? This is an additional kind of, this is a kind of income that we can use in our statement of profit or loss if we wanted to realize it, so to speak. When we sell the building, we can get this 100,000, right? It's a gain that we've stored. So logically, I'm doing the logic before I do the T accounting. So the logic tells me that currently it's 3 minus 0.4, which is 2.6. It's fallen all the way to 2 because it says that it's now only worth 2. So that's 0.6. And then I'm telling you also as well that as opposed to hitting yourself with 0.6, you can therefore offset that by 100,000, because it's not a complete fall. 0.6, but you have this there. So the question here is, how do we deal with the T accounting? So what we actually do is we create our, if you like, loss on sale, or loss on, or just evaluation, loss on evaluation, or statement of profit and loss. It doesn't matter what you call it. So really, the first thing we sort of first of all do is to transfer this 0.4 million out of here into the income statement. So we have that first. So 0.4 coming out of accumulated depreciation into the statement of profit and loss. So look at that. That's gone now. That's kind of here. So this looks as though there's income here of 0.4 million. It just looks like that, right? It just looks like that. The next thing I also do is to transfer this revaluation reserve from here. So that's 100,000 coming out of there into the income statement as well. So that looks like income as well. So that's 0.5 right now. Now what I can finally do is just hit the cost account with 1 million. So debit this and credit the cost account and debit this. So you can see that I've arrived at where I'm trying to get to. Nothing in the revaluation reserve, nothing in accumulated depreciation, and my cost is now 2 million brought down. And if you like, I have an overall loss of 0.5 million, right? Because there's 5 million, 0.5 that looks like a gain here, and 1 million that looks like a loss here. So overall, I have a loss of 0.5 million, right? And so that's kind of how we deal with the double entry, right? And you just need to kind of practice that. But again, I always say you need to do it logically in your head first to sort of see where you're going, know why it is you're trying to arrive there, and then you should be fine. Cool, great stuff. So that's the end of chapter 4. 30 minutes of work, and then in terms of questions to do from your exam kit, which you have to please do, I will do a few as well, but you need to kind of make sure you do these as well. You need to do, here we are, question 19, 37, and 38. So please have a go, and then let's discuss later on. Thank you.